Hi, so if you've been following me for a while, you will know I'm looking for small cap companies that could potentially be 100 baggers. And although I think there is still a place in my portfolio for large caps, the big advantage I get as a small investor without institutional money is that I can look in this small cap universe that is neglected by the big guys. There's just more chance for inefficiencies. But today is a complete exception. I've been watching this company for years now, and the price, in my opinion, has become very compelling. I have made videos on Alibaba before, so check them out to see in more detail about the company and how I think about this investment. But today, I'm going to go through my investing thesis on Alibaba and that I'm now invested. So I'm going to go through the positives, the negatives to look out for, my valuation strategy, and then my expectations on my return on investment expectations. So one of the big positives here is that Mohnish Pabrai, Charlie Munger, the Tweedy Brown Value Fund, Ray Dalio, and many more super investors have been buying Alibaba. They're buying somewhere between $220, maybe $210 to $240 a share, somewhere around that range. To $220, that's pretty good. Now, as you can see, I've pulled this information from Dataroma, and it's showing the top 10 buys last quarter. So that's Q1 2021. Haven't got Q2 yet, but Alibaba is the number 4 in the list of the top 10 buys. And for buys by percentage of a portfolio for the last quarter, well, Alibaba is number 1. So look, there are a lot of very famous, very good, experienced value investors buying into Alibaba right now. And look, if that doesn't give us an incentive to go and study the company ourselves, well, I don't know what will. Mohnish Pabrai is probably my favorite investor, and it's really compelling to invest alongside someone who I consider as the best in the world. No matter how much research I do on Alibaba, it's just not going to compare to the decades of experience from these famous investors. They have been through many cycles, investigated thousands of companies. So when they invest heavily into a company, it is a massive tick of approval. The company has already gone through some extremely strict and thorough filters to reach the portfolios of these famous investors. So I think this gives us all a lot of conviction. Sure, they might be wrong on this and we can't predict the future, but it's definitely far better having these guys as investors alongside us. Now, looking into the future, I think there's a big opportunity for Alibaba in their cloud services. So cloud computing currently makes up about 8% of the revenues for Alibaba. But I think this is where just a lot of the future, like the next 10 years growth is going to come from, like I said. So like AWS from Amazon, so that's Amazon Web Services, Alibaba Cloud essentially acts as a toll bridge to the internet of China. Alibaba Cloud grew at over 60% year on year and is the number 1 provider in the Asia Pacific region, and they're now 3rd in the world. The margins of this part of their business are exceptionally high and is probably what I am most excited about moving forward. And this is the upside potential that we might get that we are hardly accounting for when I do the valuation. So AWS at the moment is 6.5 times bigger from a revenue point of view than Alibaba's cloud, but Alibaba is on track to catch Amazon AWS possibly in 5 to 6 years. That is exceptional growth. Okay, so now I'm going to address some of the negatives that people come up with when they're talking about Alibaba and what is the negative thesis here. It's good to be aware of these and see whether we can talk about these openly and make sure that we understand them. So the first one, the ADR listing. So where you buy this on the New York Stock Exchange, well, it technically means you don't own part of the ownership of Alibaba. See, what's going on in China is that because Alibaba is technically a tech company and a Chinese company, they don't allow foreign investors into their tech companies. But what happens is that everyone's got around this by listing on the New York Stock Exchange through these ADRs. Now, look, the super investors seem very confident to go through the ADR system. It would be very, very weird for the Chinese government to interfere in this particular part here and say that no foreigners can own Alibaba or Tencent or anything like that. I think that's very dramatic and very, very unlikely. But there is a tiny risk here that because you technically don't own the shares, it's held in this like Cayman Islands holding company. Well, there is this tiny little bit of risk there that you should be aware of. So look, I'm not worried about this at all. Charlie Munger, Mohnish Pabrai, these guys aren't worried about it either. So I think they understand this a lot more than I do. I'm happy to tailcoat onto their ideas at the moment, but look, it's something to keep an eye on. It's something to know about. The next thing is the delisting concerns. Now, this was probably more like 3 or 4 months ago, maybe 6 months ago now, especially when Trump was in the White House still. So they were thinking that they would remove like the Chinese companies from the New York Stock Exchange and just keeping them listed in Hong Kong. Now, apparently, this wouldn't affect any of us anyway. We would just have our shares on a different exchange. Actually, it was probably going to move from the New York Stock Exchange over to the OTC market, so over the counter. This wouldn't have been a problem. We would still have the same shares. Everything would still be the same. It just wouldn't be on the New York Stock Exchange anymore. Yeah, okay, maybe that doesn't provide as much liquidity as it could have on the New York Stock Exchange. But look, Alibaba is a massive company. If it did go into OTC, I don't think we'd have any issues with liquidity anyway. I don't think this is a concern, so I'm going to just let that one go. The next thing I wanted to point out is there is fierce competition in e-commerce just throughout the world. So Pinduoduo is rapidly growing throughout China. That is backed by Tencent as well. So look, there's something that could maybe interfere with the growth prospects of Alibaba. JD.com is obviously a big competitor as well. We got Amazon and Shopee. Now, Amazon obviously is American-based and European-based and now Australia and Japan. Maybe they set their sights on Southeast Asia as well, which I wouldn't be surprised about. There's something to watch out for there. Amazon's obviously a big competitor. And Shopee, now that's actually run by C Limited, and C Limited is owned, I think about 25 or 30% of C Limited is owned by Tencent. Now, Shopee, you probably haven't heard of this before, but Shopee is a really interesting e-commerce company growing rapidly in Indonesia specifically, in Southeast Asia, Vietnam and Thailand and places like that. But Indonesia is the really big growth market there. Now, they're just taken over lead market share of Indonesia. And I think that's a big threat for that Southeast Asian market. And Alibaba are losing the race in that space to Shopee. So it's something that might affect their growth prospects in the future. Not quite sure what will happen in this space, but just the competition is fierce in just the general e-commerce world. And that's a negative in my eyes. Now, the last point here is China's increasing regulations on their big tech. So this is probably why the share price has fallen recently, I think. Now, Alibaba, potentially, they've been talking about maybe it's just so big that they have monopolistic practices now, that they own Alipay and AliExpress and like all the logistics and all these things, that a seller kind of is stuck into this ecosystem. And because of that, they control a lot of the prices and things like that. And maybe there's some anti-monopolistic behavior. Apparently, they've been fined already. So look, I don't think this is as big as a deal as it was made out to be. And I think the share price probably should have recovered by now, but it hasn't. Another thing is that Alibaba, the government could tell them to break up all of these parts so that these different spin-off businesses have to then compete against each other. What this would mean for us as Alibaba shareholders is, instead of owning the Alibaba group, we would own Ant Financial, we would own Alibaba.com, we would own the logistics company, we would own the movie company, we would own the cloud services business, all as individual companies. And look, I don't see that being a massive problem anyway, and we can always reevaluate each one of those spin-off companies if the time comes. So in my eyes, I think the risk isn't that great. I think the market has maybe overreacted a little bit here. So that's my opinions on the negatives. Please feel free to let me know some more negatives if you have them, but I think they're the big four at the moment. Let's move on now to my valuation. So my first valuation here, I'm using a big margin of safety. So the growth rates for the next 10 years. What I've done here is I've used 30% for the next 5 years. Now, look, I've seen some people use 15%, some people use 25%. I actually think they're going to be growing at a fair rate here. And I think 30%, considering the last decade has been over 40% across nearly every metric. So 30% doesn't scare me. And I think bringing it down to 20% over the rest of the decade is totally achievable. So anyway, let me go on with this valuation anyway. My discount rate, now I'm using a massive discount rate here of 30%. That would be what I want to get as my return on investment in an ideal world. And that'll include a big margin of safety. So the difference for trying to hit 30% per annum and say 26% or 20% is actually very dramatic. It seems like it's only a few percentage points, but that compounds really, really dramatically over that 10-year period. So at 30% margin of safety, we actually have a really big, at 30% discount rate, we're actually getting a really big margin of safety. So if they don't hit 30%, it's probably likely that they might get 26%, maybe 24%, something like that. There's a fair bit of margin of safety built into that 30% number. Now, the multiple I can sell it for is around about roughly what it's trading for at the moment, which is about 20 times free cash flow. This is the free cash flow number. It's 25.5 billion. This is in US dollars. Shares outstanding in billions. The total cash, they have lots of cash, very little debt. The balance sheet is fantastic in this company. And I have a very, very good buy price at about $180. Now, it hasn't been down $180 for a long time. And that would be just a big entry point if we ever get to $180, in my opinion. Let's move on to what I would say is a more fair margin of safety, not that aggressive 30%. I've now dropped the number down to 26%. 26% is something that I use for my discount rate quite a lot at the moment, because 26% is a very interesting number that if you can grow your money at 26%, every 3 years, you're doubling your money. If we can do 26% for any length of time, maybe a decade or two, that's going to make anyone filthy rich. So that's what I'm trying to do, is keep this 26% number. But if I don't get 26%, there's a fair bit of margin of safety built in here that it should hopefully only go as low as 20%. That's what I'm doing here. I'm using these high discount rates to incorporate a margin of safety. So now we have $223 as a good buy price to try to hit this 26% number. Okay, now I have what I called a fair margin of safety. So that using that 26% discount rate again, but a more competitive multiple. So I've actually said there's going to be a little bit of multiple expansion, maybe up to 25% price to free cash flow here. That's this number here. The reason I use 25% is because comparing it to other companies like the Googles and the Facebooks and the Amazons and those, they run a lot higher than 25 at the moment. So I'm thinking that, well, look, for a company that's growing at very good growth rates, I think we can get at least 25 times free cash flow. So I've expanded that a little bit. I've also expanded the growth rate a little bit, hoping for a bit more of this is more of an optimistic scenario. And I think under $300 in an optimistic scenario still could be a very good entry point into this company. So they're my three valuations. I've got 180, 223, and about 300. You can see how that's dramatically different from each other, but I'm just sort of getting a feel for what I think a fair price would be. I think these growth rates are maybe a little bit too on the optimistic side. I prefer to bring it down to 20% like this one. So 223 felt a little bit more comfortable and a bit more safer for me. Who knows, maybe I get good multiple expansion. Maybe these growth rates do go a little bit higher. Maybe they go a little bit lower. I feel like 223 is a nice safe number. Now let's move on to the thesis that I've put together for this investment. So my points are this for why I'm investing in Alibaba. There's strong long-term China and Asia internet growth tailwinds. The population is massive. A lot of them are only just coming online only in the past few years, and that's expected to continue the rest of the populations are supposed to continue to come online for the first time. You've got a lot of rural China, you've got a lot of Indonesia, Vietnam, these types of places. The population in this area is just gigantic. It's I think it's 6 or 7 times as big as the States, these 7 or 8 countries in Southeast Asia and Eastern Asia. So look, there's just a lot of tailwinds there, and a lot of them are becoming more internet savvy and skipping and going into e-commerce, especially because of the pandemic as well, has really boosted all of this internet growth in this area. And I just think there's a lot of tailwinds pushing it forward for the next 10 years. Alibaba are just in a prime position to take advantage of that. Now, the next point is there's just many super investors already filtered this out for us, and this gives us a lot of conviction. The cloud expectations are to grow fast and potentially beat our expected growth rates on the upside. So like I said 30% for the next 5 years, 20% for the 5 years after that. But cloud could just blow this out of the water. We could really grow it this could continue to grow at 40%. We don't know, but cloud could be this massive growth driver that just gives us this big upside potential that we haven't really factored into those growth rates. So we don't really know where cloud's going, but I think it's going to be really big. If it is, that's just extra. That's just, what do we call it? It's a cherry on top. They have many unprofitable businesses at the moment. So they have so many different things going on throughout China, but a lot of them are going to turn profitable at some point. So this has also extra upside. I don't know how these are going to go. They got the movie franchises. They've got lots of other things going on, lots of other apps and lots of other payment gateways and all these things. There's lots of upside potential in the company because it's this massive conglomerate. And I think they have a really strong ecosystem competitive advantage. It's just going to be really difficult for somebody to come in and displace them from the Ant Financial, the payment system of Alipay, using Alibaba.com and Taobao and 1688.com and the ecosystem already built in and comfortable with a lot of the businesses of China. It's just going to be really hard to dethrone them. Things to watch for: China's government seriously wanting to break up the company. That would be something that I would be concerned about, and I'd want to investigate a lot further if they were going to take that a lot more seriously. Another thing to watch for is if there's dramatically slowing growth rates. So this is something that I'm going to just keep on top of each annual report. So if I see that, okay, it's 40% for the last decade, let's say it was a lot higher than that for the last 12 months. But if I see it sort of creeping down to 20, 15, 10%, that's something I'm going to watch out for. And I have to redo my valuations if I can see dramatically slowing growth rates. Now, if the super investors like Mohnish Pabrai and Charlie Munger, if they sell out completely, I'm definitely going to take notice of that and reevaluate my entire position as well, because these guys are smarter than me. They're smarter than all of us. If they sell out completely, there's a reason for that, and we really need to pay attention. So that's the things I'm watching out for. So here's my expectations for this investment. My returns if I could buy at 180, I'm hopefully going to get 30% per annum. I don't think I'm going to get $180. I'm trying to buy at 223. So I'm gunning for 26% per annum. That's my hopeful return on this investment. Now, I think for the downside protection at this 223, I think a low-end bad case scenario is maybe 15%. What I did to find this 15% per annum was I dropped the growth rates down to 15% for the next 5 years and 10%. And it told me that at 223, I'll probably get about 15% per annum on my money. That is a pretty great low-end bad case scenario, in my opinion. Another thing that gives us a lot of downside protection is the balance sheet is just really solid. The debt levels of the company is actually only a quarter of the cash that they have in the bank. So they could pay out all the debt right now with only a quarter of the cash that they have available. So look, debt is not a problem. Balance sheet is amazing. That gives us a lot of downside protection. This company is not going bankrupt. That gives me a lot of confidence for the investment. I'm really positive about Alibaba, as you can probably hear. Check out my other videos, how I've gone and broken down the company. I did it about a year ago, and I broke down each individual part of the business. If you want to find out a little bit more about what's actually going on with Alibaba.
So I hope you enjoyed this video, and if you did, please hit the like button for me so I can get some feedback on whether this was a good or a bad video. The likes do help the video spread to more people who might be interested. The brokerage accounts that I use to buy my investments are Interactive Brokers and Saxo Bank. Now, I have links in the description. These are the safest two brokerage accounts that I personally use. Look, don't get sucked into those free trading apps like Robinhood. Those don't give you access to international markets either. Now, my links are affiliate links, so if you want to support my channel, that's the best way to do it. And please also remember that this is all just my thoughts, and I'm sure I have plenty of biased opinions, so please take responsibility for your own decisions. I'm not going to ask for a cut of your profits, so don't blame me if you lose money. Thanks for staying to the end, and I'll see you in the next video.